Adine wayitangije
nayitangije umukobwa bataraza
ko ndeba nta muntu uraza
barimo bararya
hari hiyandikishije nk'abangahe hari hiyandikishije nk'abangahe
uyu munsi
kuri iri somo
dufite reka turebe hariho 30 ariko baraza
ko bari gutinda se
nawe wari wajoyininga none
wapi urabutegerejeho akanya gatenoke
nta kibazo mbe ngumye online
kabisa
sawa
Adine Enoch. Enoch.
Yes, yes.
So for the interest of time, we can start. Good afternoon, everyone in this panel. My name is Inyirinde Kosterato. I'm principal examiner of ICPAD. I'm together with Enoch, who is the one who is going to pass through this financial reporting. So it is not like a teaching as such. It is how it he's going to come up how to approach exam, how to extract the data from case study, how to manage the time in the exam. So it is like kind of guidance to pass exam. So Enoch, floor
Yes,
is
yes.
yours.
Thank you. Thank you for everybody in this session. My name is Enoch Shimimana. I have experience in teaching this FR for CPA candidates. So now I'm delighted to present to you this slide about exam preparation for this December 2020. Due to this pandemic, COVID-19 occurred over the world, so candidates did not get opportunity to attend trainings. But this is the opportunity for you to go through this FRA exam preparation so that you will pass and you will get high marks in this December 2020. So before proceeding, I would like to confirm that everyone can hear me very well. So can you hear me very well?
I can hear you.
Okay. So let's start. Though we have few others will join us later. This is the first slide. It is the topic about we are going to go through financial reporting exam preparation December 2020. This is for intermediate level. So the presentation agenda we are going to go through, it is about summary of FR chapters and revision guidance. Financial reporting book has include covering many chapters, but we are going to go through and summarize some chapters and revision guidance. The next will be exam techniques and exam tips. And the next will be exam specific information. And I would like to give you exam instruction, how the format of FR exam, and there are some questions which are compulsory and the others you have option to choose. The next will be to analyze, how to analyze past papers and making links between different topics. So, I hope you read the book of FR. So there are many chapters, but I'm going to go through them in a few minutes. Then after summarizing them, I will give you some exam techniques. I want this session to be participative. So I need also participants to participate in this session. And at the end of this session, we will ask questions and giving some ideas. So let's start from summarizing all chapters in FR book. In exam, they make sure 80% coverage is examined. So that's why I'm going to revise for you these chapters. So the first chapter I want to start with is group consolidated financial statement, where we are going to go through how group accounts are prepared, combining parents, subsidiaries, associates, and joint controlled entities. The next will be relevant international accounting standard, international financial reporting standard. We will go through these different standards, and the next one will be statement of cash flows and interpretation of financial statement using financial performing ratios. The next will be company accounts. The next will be international public sector accounting standard factors. So let's start from this group account. Group consolidated financial statement. I'm going to summarize it. So when you look at this topic, it always comes in exam because it is a very important chapter in this paper, and it is always comparison. So you can be asked to prepare consolidating statement of financial position, statement of profit and loss account, statement of changes in equity, even consolidating cash flow. So this is covered under IS 27, IS 28, IFRS 3, IFRS 10, IFRS 11, and IFRS 13. And as you know, this IFRS requires each company in a group to prepare its separate financial statement, but in addition, parent is required to prepare consolidated financial statement. When you are consolidating parent and subsidiary, so this is treated as a single entity. Parent transactions occurred between parent and subsidiary. At the end of reporting, when you are consolidating, you do full consolidation. You combine item line by line of parent and subsidiary. For example, you are starting from consolidating income statement. You start sales of parent plus sales of subsidiary. Cost of sales of parent, cost of sales of subsidiary. Then you combine expenses of parent and expenses of subsidiary, asset of parent and asset of subsidiary. But you remember to eliminate some intercompany transactions occurred between parent and subsidiary, because for parent and subsidiary relationship, parent has control over subsidiary. It invested over 50% shareholding. So for here, when you are tackling the question, you start by establishing group structure and to know date of acquisition. Group structure helps you to know how you will consolidate and how to determine percentage of shareholding. When the percentage of shareholding are not given in the exam, you compare, you compute percentage of shares acquired and total shares in subsidiary. Then uh, uh, if you get group structure, it's the one you will base on when you are determining when you are computing some other adjustments like goodwill and other workings. For example, a parent has 80% in a subsidiary. So it means the remaining percentage not owned by parent. It is part of non-controlling interest. So So here, you start with establishing group structure and date of acquisition. Then you know the principles of how combining each item of parent and subsidiary and how to eliminate those intercompany transactions in order to avoid double recording. So another important thing is date of acquisition. Here, date of acquisition is very important because in exam you may be given a case where subsidiary was acquired during the year. So here, you apply pro rata basis on expense and income. You do accrue even. You prorate months you own the subsidiary. And date of acquisition helps you to determine pre-acquisition profit and post-acquisition profit. Pre-acquisition profit will helps you when you will be determining um, goodwill. And post-acquisition profit will help you when you are determining group retained earnings. Another important adjustment here working, it is goodwill. So remember here I'm showing you how you may consolidate statement of financial position. You first you establish a group structure, you determine pre-acquisition profit and post-acquisition profit, and you determine the goodwill. And you know goodwill, you compare cost of investment and the value of net asset of subsidiary at date of acquisition. So when there is a positive goodwill, in exam they give you impairment, then impairment will will be adjusted under retained earnings. And the goodwill will go to consolidated SOP, statement of financial position, as an current asset of the group. And you will also determine an controlling interest in a consolidating financial position. And a controlling interest, it is a part of equity of the group. And the group retained earnings, you have to read the book, then you master how to do these workings, group retained earnings, non-controlling interest, and the goodwill, because in the exams they have some specific marks, and there is and in exam they give you additional information about intertrading, intergroup trading, when there was intergroup transactions or intercompany sales of goods or PPE. So you have to eliminate sales in both sales and the cost of sales in consolidated income statement. And you determine analyze the profit on closing stock. Though the stock remain unsold at the end of the year, you determine analyze the profit, and analyze the profit is used to adjust group retained earnings and the inventory, and the intergroup debt or current account should be fully eliminated. And as you know, inter parent and subsidiary, when you are doing consolidation, you assume they are a single entity. That's why intercompany debt, the company loan between the parent and the subsidiary are fully eliminated. Another statement you will be asked in the exam is consolidating statement of profit and loss account. When you are consolidating statement of profit and loss account, it is easy. So you do income, you prepare income statement as usual. You start from sales minus cost of sales, gross profit plus other income minus expenses, administration expense, finance, and other expenses, then to determine profit before tax. But when you are consolidating, you add item, line by line item of both parent and subsidiary. But at the end of this statement, you have to split profit attributable to non-controlling interest and profit attributable to parent. And those intergroup trading, when there was intercompany sales, so it is eliminated in the both sales and the cost of sales. And when there was there is the profit on closing stock, it is added back to the cost of sales. And when there was an realized profit on opening stock, it is deducted from cost of sales. And for dividend, you know, post-acquisition dividend for post-acquisition dividend, it was already recognized by parent books in its income statement as investment income. Here, investment income is you have to eliminate parent share recognized in investment income. And in the balance sheet, you eliminate it when there is dividend payable in the current asset, but part of NCI, it remains as current asset of the group, as current liabilities of the group. Another trick is when subsidiary was acquired during the year. So what you do here, you you accrue even income and expenses. You apply months you have subsidiary during the year. Then you have to know how uh, how to split profit attributable to non-controlling interest, profit attributable to parent. Profit attributable to non-controlling interest, here you apply the share of NCI to the adjusted profit of subsidiary. So another thing you have to know is how to consolidate associate. For associate, you don't do full consolidation. You don't consolidate associate line by line as we do for subsidiary, because here associate is not considered as where we have control. Parent does not have control over associate. It rather have significant influence. So here we use equity method, accounting equity method. When you are consolidating associate method, it delivers cost of investment in associate is initially recognized at its cost, then you adjust post-acquisition changes, post-acquisition retained earnings and impairment. So here I gave you some formula. You take cost of investment plus parent share of post-profit less impairment losses. This was to of the group, and it appears under income statement, and you show shares of associate profit after tax and less any impairment in there. So this means that associate appears twice in the consolidating income statement. It appears once in the consolidating income statement, and it appears once in the consolidating balance sheet. And when there was intergroup sales, intergroup transactions, intergroup debt, intergroup loan, so it is not cancelled here. Generally, the associate is considered to be outside of the group. Therefore, any sales or purchases and intergroup debts between group companies and associates are not normally eliminated. So, unlikely this associate, they are not eliminated. Transactions between the parent and associate, because you assume associate is outside of the group. But for parent and subsidiary, Because we are doing a fully consolidation here, you combine, you add line by line every item of parent and subsidiary, parent and subsidiary. But for associate, we use equity method, where it appears once in the statement of P&L and the statement of financial position. And when the parent has joint control over another entity, it is called joint venture. For parent and jointly control the entity, you can use either accounting equity method or proportionate method. For, for here, joint venture, it is treated as associate when you are doing consolidation. So as a summary, when the parent invested below 50%, but not goes below 20%. Between 20% and 50%, it is an associate company. The parent does not have control, it has significant influence. But when it has over 50%, it means the investee is subsidiary. So the parent has control over subsidiary. When the parent has 50%, so it means it doesn't have control, it doesn't have significant influence, so it has joint control. That investee, it is called joint venture. But when the parent has shareholding below 20%, you are no longer applying standard rating to consolidation. So it is simple investment where you can use IFRS 9 for financial instrument. So in the exam, for consolidation, it always come in the exam. The examiner may bring you a question for consolidating both income statement and balance sheet, or the question may be only consolidating income statement or only consolidating statement of financial position. So I think I remind you how consolidation is done. Uh, in the exam, and what you do, it is to present clearly your answers. You draw very well a format combining parent, subsidiary, associate, or joint venture, depend on the group structure, and you show the workings very well. For example, in consolidating balance sheet, you show clearly working for goodwill, working for group retained earnings, separate working for non-controlling interest, and even investment in associate. So there are some marks allocated to those workings. So that's why you have to show it clearly in exams. So I don't know whether you may ask question for this topic, or I can go through all those topics, then you will ask later. Strato. Hello everyone. Hello everyone. So if there is anyone with a question, Strato may help us. The next topic, it is relevant international accounting standard and international financial reporting standard. In exam, you are given scenarios and cases where you are asked to apply this standard in the questions. So for us, we have some specific standard under FR book. So Those are standard you have to go through them and understand how to apply those standard in the questions. So let's start from property, plant, and equipment. Property, plant, and equipment. This is the standard relating to tangible assets. Those are assets that company has that lasts over 1 year, above 12 months in a period. So those tangible assets include land, building, furnitures. So when you are preparing a statement of financial position, so property, plant, and equipment, it is important to know how to compute or how to measure those PPE. So when you are measuring this property, plant, and equipment, you may use either cost model or revaluation model. When you are using cost model, you compare, you have to determine carrying amount by taking cost minus accumulated depreciation. Then the carrying amount goes directly to balance sheet as in an current asset. And for revaluation model, here asset is revalued every period, and you have to know that fair value at the end of reporting. It is compared with the prices of similar assets in the market, in the active market. That's that's how they determine the valuation of the asset. At the end of the year, you compare the value of the asset, the valuation of the asset, the value of the asset, fair value of the asset at this year with, you compare it with the fair value of the asset in the previous period. Then any gain on the revaluation of PPE goes to other comprehensive income, not in the item of P&L. So for PPE, I think everyone is right PPE and how to extract statement of financial position and statement of income statement. So, and how to compute depreciation. You know, depreciation, you compute depreciation most of the time they bring using straight line basis and may use reducing balance method. uh, Another thing for PP, you have to know when examiner gives you some when their assets disposed, and that and you have to determine gain or loss on disposal, and it affects income statement. Another standard is IS-20, accounting for government grant, disclosure for government assistance. IS-20. Here for IS-20, determine government grant. Government grant. Let me go to the summary of this IS. Government grant are assistance by government in the form of transfers of resources to an entity and in return for past or future compliance with certain conditions relating to the operating activities of the entity. So the government grant is like assistance the government give to those entities. But they have to comply with some conditions. Government often provide money and incentives to those companies to export their goods or promote local employment. Government may be given to an entity in the form of revenue or in the form of assets. The government related to income, for example, the government contribution towards payroll costs. So another form of grant may be an asset. the government may buy for a company non-current asset. So here, accounting treatment for grant related to income. So here it is shown in the income statement as other income, or it may be deducted from related expenses. For example, if the government gave you this grant by covering your staff costs, so here it may be deducted from payroll cost, or you may show it in other income as government grant. So another form of assistance that requires complex that is complex somehow is grant related to asset. The treatment of this grant related to asset, it has two treatments. The first one is you may write off the grant against the cost of the non-current asset and depreciate the reduced cost. Here, and is the first current asset, then the remaining value, then you the reduced government the value of non-current asset costed, for example, 100,000. Then 20% of 20% of cost of an asset was a grant. So that means 20,000. So here you take 100,000 minus 20,000 of the grant. The remaining amount is 800 80 80,000. For 80,000 is the one you will compute for depreciation for the remaining or useful life of the asset. Another treatment, you may treat the grant as deferred income. Here, you treat it as it goes to statement of financial position under liability. Even though it is an asset, on the other side, you treat it as a liabilities, as deferred income. So here, you amortize those deferred income over useful life of the asset. Then amortization of deferred income, it goes directly to other income in the P&L account. So this second approach, it is called income approach. The first one, it is called capital approach. So let's go back to our slide.
Hello. A presenter has some technical issues. We can wait 5 minutes and come back. Enoch,
Yes, yes.
I hope now the issue is resolved.
Yeah, the issue is resolved. So I don't know whether you can watch my presentation. Um, Let me try.
Share your screen.
Share screen.
Okay.
So are you hearing me?
Yes, we are hearing you.
Okay. So you know,
So the
technology is not our friend.
so before proceeding, there is one person who raised the hand, Emmanuel Ngiruntag.
Okay. So
Emmanuel,
now they help us.
Emmanuel, so we can proceed and return to Emmanuel later.
Okay, thank you. Uh, our presentation. Let's proceed with our presentation. Uh, we are still on summary of the second chapter. So the next IS you have to know as a candidate who are preparing financial reporting exam is investment property IS 40. Here for investment property, these are properties relating to the land or other asset owned for the purpose of earning rentals and capital appreciation rather than using it for administration purpose or production purpose. Here for measuring this investment property, we use a cost model or fair value model. So when you use cost model, as you know, you determine carrying amount. Carrying amount, you take cost minus accumulated depreciation. For fair value model, you do revaluation at the end of every reporting period. Then any gain or loss resulted from comparing fair values of current year and previous years goes to P&L account. Another standard it is about intangible assets. These are uh, these are assets with no physical existence. Here, those are intangible assets such as trademarks, patent rights, goodwill. So here you will read about how measuring this intangible asset. Another standard is inventory, IS2. So here, IS2 determine how inventories is accounted for. Here, inventories, as you know, it includes the cost of inventory plus other costs attributable to the bring inventory to its location. When you are measuring inventory, you it is measured at the lower of its cost and net realizable value. Net realizable value, this is selling price of inventory minus expected selling cost. So here you determine the lower of the two. Another standard is about provision, contingent liabilities, and contingent asset. Here, you know how to determine provisions. Provisions, you know, goes to balance sheet as liabilities. It is recognized in the books of account, but contingent liabilities and the contingent asset are not recognized in the books of account, but they are disclosed. So you disclose contingent liabilities and contingent liabilities. accordingly to this standard. Another standard here, it is event after reporting period, IS10. So let's go to the summary of IS10. For IS10, event after reporting period are those events, both favorable and unfavorable, which occur between the reporting date and date on which financial statements are approved for the issue by the board of directors. So for example, if our reporting date is December 2019, and financial statement was approved by board of directors in March. So that period between December 2019 and March 2020, that we call that's the one we call event after reporting period. Those events after reporting period, there's some adjustable and others are not adjustable. So the adjusting events are the events after reporting date that provide additional evidence of condition existed at reporting date. So here example of adjusting event include recoverable debts arising after reporting date, which may help to quantify the allowance for receivables at reporting date. Another example is sale of inventory below cost, providing evidence of net realizable value. Another example, amount received and or receivable in respect of insurance claims which were being negotiated at the reporting date. Another example is the discovery of fraud and errors. Those, those are examples of adjusting events. And there are other examples of non-adjusting events. Non-adjusting events are those events after the reporting date that concern conditions that arose after the reporting date. So examples of adjusting events include recoverable debts arising after reporting date, which may help to quantify the allowance for receivable as at reporting date. Uh, sorry, this is also example of adjusting event. Adjusting event. The accounting treatment for adjusting event requires adjustment of amount recognized in financial statements. So an adjusting event should be disclosed by note if they are of such importance that their disclosure would affect the ability of the users of financial statement to make proper evaluation and decisions. So examples of non-adjusting event may be some merger and acquisition that may occur during the post-balance sheet events, uh, and the other events like this event for COVID-19. So those items affected by COVID-19 are non-adjusting events. Let's go back to our slide. Uh, the slide. So accounting policies, changes in accounting estimate and errors, IS8. You have to read this IS. The effect of changes in the foreign exchange rate, IS21. This is when there is foreign operation located in out of the country. Here you have to retranslate depending whether it is monetary or non-monetary items. Here another standard is about borrowing costs. So let's go through borrowing cost. Borrowing cost. Uh, Borrowing cost So let's start from recognizing borrowing costs. Those are interest and other costs related to the borrowing acquired to construct or produce qualifying assets. So borrowing cost must be capitalized as part of cost of the asset if the asset is a qualifying asset. So here, there is some conditions of commencement of capitalization and shall see cessation of capitalization. The IS-23 states the capitalization of borrowing costs should commence when all the following conditions are met. Expenditure for the asset is being incurred, borrowing costs are being incurred, activities that are necessary to prepare the asset for its intended use or sale are in progress. Then cessation of capitalization, it, it occurs when substantially all the activities necessary to prepare the qualifying asset for intended use or sale are complete or construction is suspended. For example, construction may be suspended due to industrial disputes, or you remember this lockdown occurred in March during this COVID-19, so where some construction suspended their activities. So even here, if there are no activities about construction, you suspend capitalization. So they are expense to the P&L instead of capitalizing them as part of cost of an asset. So let's go back to another standard. Another standard. Um, Here, another standard that that always come in exam is income taxes. Here, income taxes is covered under IS-12. We have two types of income taxes. We have current tax and deferred tax. So let's see in a few minutes the summary of these income taxes. Income taxes. So current tax, this refers to the tax on taxable income. The amount of tax payable or recoverable in respect of taxable profit or loss for the period. For example, here you take taxable income, taxable profit or loss, then you apply tax rate 30%, so you get current tax. If at the end of period there are some payable tax payables, you recognize them as payable. You debit P&L account, then you credit tax payables. So complexity comes here under deferred tax. So deferred tax refers to the difference between accounting profit and taxable profit. These differences may caused by permanent difference and temporary difference. So for permanent differences, for example, if an expense in settlement of P&L is not allowable for tax purpose, its permanent difference arises and the tax expense increases as a result. So here, the difference between accounting profit and taxable profit will not reverse. But for temporary differences, this difference will reverse in the future. This is when expenses are allowed for tax and accounting purposes, but in different accounting periods. Here, for example, depreciation rate. So for accounting purpose, you may depreciate an asset in 10 years, but for tax authorities purpose, you may be allowed to depreciate it in 5 years. So in the earlier period, You may enjoy high capital allowances, but in a later period, it will reverse. So that difference is temporary difference. So in exam, you will be required to compute temporary difference before the tax. So we go through this step. First, we will calculate temporary difference. Temporary difference, this is difference between the carrying amount of an asset and the tax base. So when the carrying amount of an asset is greater than the tax base of an asset, you get temporary difference. You get taxable temporary difference. But, but when the carrying amount is below tax base, you get deductible temporary difference. Sorry. Uh, differ when you get taxable temporary difference and you apply it to tax rate, you get deferred tax liability. Deferred tax liability is about taxable temporal differences times tax rate. Then this will goes to statement of financial position. Then you will compare deferred tax liability at the end of reporting period with deferred tax liability of the previous period. Then the changes. When there is increase in deferred tax liability, it is an expense. When there is a decrease in deferred tax liability, it is an income. Then it goes directly to P&L. So means that in the P&L, we have year-end estimate given in the question. You add under provision. These are the tax of previous years paid in the current years. Then if it is over provision, you deduct it. Then you add increase in deferred tax liability. When it decrease, you less it. Then the balance charge to go to P&L. For balance sheet, current tax year-end estimate will go to current liability under current liabilities as current tax payables. And for deferred tax, when it is deferred tax liability, it goes to non-current liability. If it is deferred tax asset, it goes to non-current asset. Here, what you have to remember, when you get taxable temporal difference, it will result into deferred tax liability. When you have deductible temporal difference, it results into deferred tax asset. Because when you take deductible temporal difference, then you apply it to tax rate. Let's say 30%. You get deferred tax asset. So this is in the exam, you'll be given a question on income tax. What you will do it is to compare deferred tax. It is to compare tax base and the carrying amount. And you may be given additional information in the question of published financial statement, where you will be required to draw complete income statement and financial position. Or you may be given a scenario where you will be required to draw um, extract income statement or extract balance sheet. Let's go back to our slide. Then another standard you have to know is about financial instrument. Financial instrument is about it is covered under I1.2, I1.9, I1.7. Financial instrument it, it arises due to contractual agreement where for one entity it will it will be financial asset and it will be financial liability or equity instrument to another entity. So for financial instrument, you have to read about the classification of financial instrument. You have financial asset, financial liability, equity instrument, and you have to know the recognition of financial instrument. Financial instrument is recognized when an entity become a party to the contract. And financial instrument, you have to know the measurement of financial instrument, how they are measured for initial recognition and subsequent measurement. For example, financial asset may be classified as financial asset at amortized cost, financial asset at fair value, through P&L or through other comprehensive income. So another standard fast adoption of international financial reporting standard. This is the IFRS 1. Another standard interim financial reporting. This is covered under IS 34. Another standard it's about agriculture. This is covered under IS 41, where the business has farming activities or agriculture, plant and animals. So another standard, this is about operating segment, it is covered under IFRS 8. Another standard you have to know it's about non-current asset held for sale and discontinued operation. This is covered under IFRS 5. So I have to talk through this IFRS 16 on leases and revenue from contract with the customers. IFRS 15. These are a recent standard because this IFRS 16 it was under IS 17, but now it changed to IFRS 16. There are some updates made on this IFRS 16. Another IFRS 15, this was covered initially under IS 11 as construction contract and IS 18 as revenue. So they are, all of them are combined and updated under IFRS 15 as revenue from a contract with customers. So let's go through to these two standards, then we jump to another chapter. Uh, so RIS. So as you know, RIS is about contract between lessor and receiver, where receiver where lessor an asset to the receive and the rights of use an asset. In return, receiver has to pay RIS rentals for periods, series of periods. Here, this IFRS 16, it is effectively applied from January 2019. So in the books of receipt, there is no need to classify receipt as operating lease or financing lease. No. Here, this IFRS summarizes it by saying that all leases should be treated as an expense in P&L on a straight line basis, as long as leases with a lease term of 12 months or less, or lease where underlying asset has low value when new. For example, you may have an asset as a lease, for example, personal computers or office furniture. These are items considered as low value. And if the lease contract has less than 12 months or 12 months, so these two conditions, the IS allows you to take it as an expense in a straight line basis. Uh, and if it is a risk over than 1 year, so how it is treated, you have to determine a risk liability and rights of use an asset. On one side, it is an asset, on the other side, it is a liability because you have to make risk rental payments over risk term. The risk liability is initially measured at the present value of the risk payment payable over the risk term, then discounted at the implicit rate in the risk. Here, you discount all future payment on the risk, then it is treated as risk liability. For right of use an asset, it is initially measured at amount of risk liability plus any initial direct cost. For subsequent measurement, rights of use an asset, you may use cost model, where the asset it will be depreciated over the lease term. For lease liability, you will be required to adjust interest and the lease payments. For lease liability, it, to go in the balance sheet, take lease liability, opening balance plus interest expense minus lease payments. Then the remaining balance is lease liability that will goes to the statement of financial position as non-current liabilities or current liabilities. So in the books of Resa, there's no big difference between how it was treated before these changes. How it was, if you remember how it was treated under I-17, it's the same as here under I-516 in the books of Resa, where there is an update in the books of Resi. In the books of Resa, you have to split risk or determine to identify risk whether it is finance risk or operating risk. If it is a finance risk, you treat it as income, rental income on straight line basis. When it is finance risk, you determine risk receivable, net investment, then you recognize an asset and you determine and you recognize profit or loss on disposal. So let's go to IFRS 15 revenue. Here, revenue recognition, you have to know this 5-step process of recognizing revenue. First one, you identify the contract. So is it the contract between the buyer and the seller? Another step is you identify the separate performance obligation within the contract because all parties, every party has an obligation to the contract. Another step 3 is to determine transactional price. This is about contract price. Step 4, allocate transactional price to the performance obligation in the contract. So here you combine step 2 and 3. Another step 5, recognize the revenue when or as performance obligation is satisfied. This 5 step was examined in the last exam, FRA exam, in December 2019. These steps was examined. So let me give you an example to understand what those steps. Let's take an example. On 1st December 2019, XYZ Limited receives an order from customer for a computer as well as 12 months of technical support. This XYZ Limited delivers the computer to the and transfers its legal title to the customer on the same day. The customer paid 420 francs on 1st December 2019. The computer normally sells for 300 francs and technical support for 120 francs. So here, if we received an order from a customer for computer as well as technical support, here we have two obligations to deliver computer and technical support. The customer paid this amount, 300 as the cost of an asset, sales of an asset, and technical support for 120. Here, first of all, you have to determine whether there is a contract. Is there any contract or agreement between our company and the customers? So yes, there is an agreement between XYZ Limited and its customer for provision of goods, computer, services, technical support. Step 2, identify separate performance obligation. Separate performance obligation. Uh, Here, each party has performance obligation. For us, we have performance obligation to supply computer and technical support. Another one has obligation to pay. So transaction price is 420. Then step 4, you allocate transactional price to the performance obligation in the contract. Based on the standalone sales prices, 20 francs 300 should be allocated to sales of computer because they already performed our obligation. But for 120, we should allocate this 120 over 12 months. Here, technical support is provided over time, so revenue from this should be recognized over time. Here, revenue will be 120 times 1 over 12 because by the end of December, 31st December, it's only 1 month. So that's why we determine income based on services we provided. So our sales will be 300 plus this 10. So here, let's go back to our slide. My slide. The next chapter will be, you will be required in exam, preparing financial statement, presentation of financial statement, and the concept framework for financial reporting. Here, as a FRA candidate, master, you should know very well how to prepare statement of financial of income statement or statement of profit and loss account. Here, you have to be able to determine gross profit or loss, net profit or loss, and other comprehensive income. You have to determine also to draw very well statement of changes in equity, statement of financial position, statement of cash flows, notes to financial statement, concept of framework for financial reporting here. So, so you have to do many exercises as possible. And for these questions, where you will be required to prepare financial statement, most of time it always come in exam. Another chapter here is about statement of cash flows, IS7, and the ratio analysis. Here, uh, when it comes in exam, you you may either choose to use indirect method or direct method. So as you know, statement of cash flows, it shows us the movement of cash in the business. At the end of reporting period, it shows us net cash flow. And as you know, either direct or indirect method, you prepare cash flow statement using by showing three headings. Heading 1, cash flow from operating activities. Heading 2, cash flow from investing activities. Heading 3, cash flow from financing activities. And you have to add net cash flow from all three activities. Then you add it to cash and cash equivalent at the start of the year. Then you get cash and cash equivalent at the end of the year. So here, preparing statement of cash flow. Let me show you format of how to prepare statement of cash flows. So here is to remind you the format. Statement of cash flows. So using indirect method, here you adjust profit or loss before tax, then it is adjusted by non-cash items. So here you start from profit before tax, adjustment for depreciation. Here, let's say it is consolidated cash flow. You add it parent share of profit from associate or joint venture, finance costs, investment income, for for expenses, you deduct it for expenses here. Non-cash items, if it is expensive, you add it. If it is income, you deduct it. Here, depreciation, you add it. You have to eliminate it. Parent share of profit, you deduct it from associate. Finance costs, you add it. Investment income, you deduct it. Profit or loss on the sale of non-current asset. Profit on the sale of PP, you deduct it. Loss on the sale of PP, you add it. Government grant amortization, you deduct it. Impairment of goodwill, you deduct it. Then you get operating profit before working capital changes. Then for working capital changes, we mean change in inventories, change in trade receivables, change in trade payables. If there is a change, if there is an increase in inventories, it means cash outflow. When there is a decrease in inventories, it means cash inflow. Increase in account receivables, it means cash outflow. Decrease in account receivables means cash inflow. For trade payables, when there is an increase, it means cash inflow. When there is a decrease, it means cash outflow. Then you get cash generated from operation. Then you deduct interest paid. Those are the cash paid, cash out, and the tax paid. Then you get mainly cash from operating activities. Another activity is the cash flow from investing activities. Here, you show purchase of PP, acquisition of PP. This is the cash outflow. Proceed from sale of PP. This is inflow. Proceed from government grant, inflow. Interest inflow or outflow. Dividend received from associate or joint venture. This is inflow. Then you get net cash flow from investment activities. The last activity is cash flow for financing activities. Here, you get proceed from issue of shares, proceed from long-term borrowings, payment of lease liabilities. Cash. This is the cash outflow. Dividend paid to NSA. This is the cash outflow. Dividend paid by non-current parent. This is cash outflow. For dividend paid and interest paid, you may either choose to put it under financial activities or operating activities. Then for this net increase or decrease in cash, this is a total of three headings. You add it to cash and the cash equivalent at the beginning of the period, then you get cash and the cash equivalent at the end of the period. So for cash flow statement, it includes many adjustments, many workings. determine every item, but once you do exercises, it is easy to determine this movement of cash flows. Uh, Another topic is ratio analysis. Ratio analysis, it's about sorry, ratio analysis. This is also a topic that is examined in the exam. So we have types of ratios. So you should know liquidity ratios, profitability ratios, investment ratios, solvency or gearing ratios. For liquidity ratios, you have to know how to apply or how to compute current ratio, quick ratio, stock turnover, debtors collection period, creditors payment period, and to interpret them, because liquidity ratio shows us the liquidity position of the company, where it shows the position of the company or a bit of the company to convert asset into cash in short-term period. For profitability ratios, it is shown by gross profit margin ratios, net profit margin ratios, return on capital employed, and the return on asset. Another one is investment ratios, earning per share, dividend yield, dividend cover, earning yield, price earning ratios. For solvency and gearing ratios, you should know debt to equity, time interest earned ratios. So here, I think you, you, you revise very well also this chapter for cash flow and even ratio analysis. Let's go back to our topic. Another topics you have to cover, it's about company accounts. These are the financial statement of different various types of organization. For branch accounting, insurance companies account, bank clubs and liquidation companies accounting for consignment background to consignment accounting for banks. So you will also devise the preparing financial statement of these types of organization. Another topic you will be required to go through to revise is International Public Sector Accounting Standard, IPSAS. So here, IPSAS, it is set by IPSAS B, but for this International Public Sector Accounting Standard, it is applied to the public sectors only. This IPSAS, it is set by referring it to IFRS. So most of them are the same as IFRS, so there are some minor differences. So you have two types of IPSAS. You have IPSAS cash basis, IPSAS accrual basis. So here in exam, you will be required to, for theories session, to know what is the advantage of IPSAS, difference between cash basis and accrual basis, and to know about more about different IPSAS covered in the FR book. So here, even you have also to know how to prepare financial statement for public sector, statement financial performance, statement for financial position. So financial statements are the same as private sectors, but for IPSAS, you have to show also comparison between budget versus actual performance. So financial statement for public sector, it requires that statement of comparison of budget and actual. Uh, so here some that you have to go through. For example, here accounting for revenue in the public sector, IPSAS 9 and 23. You have to know revenue from exchange transaction and revenue from non-exchange transactions. Cash flow statement for IPSAS 2. Here it's the same as IS 7 cash flow statement, inventories, IPSAS 12 is the same as those inventories for IS 2. So most of IPSASs were set referring to IFRSs. So here IPSAS is not difficult. So here the summary of FR topics. I think we have covered every item. Uh, the next the next is exam techniques and examination tips. And as you remember, we have our agenda, we have 4 items. Summary of FR chapters and revision guidance. Here we complete it. So the next title is exam techniques. So for passing this FR, it requires more preparation because you cannot pass this paper if you did not prepare very well. So first of all, get well prepared, revise all topics or chapters, and because in exams they try to they try to examine 80% coverage. So for you to pass it very well, you have to revise all chapters. So tip one, candidates should adequately prepare for examination to get high score marks. Some candidates lack of adequate preparation of exams. They do not cover the syllabus adequately before sitting for examination. So some candidates they wait for miracles in exam uh, and the other and passing examination without studying. So I think I cannot give you assurance pass this paper if you didn't prepare it very well. So go to past papers and try to correct those past papers and try to revise all chapters in the FR books. So this advice will help you to pass FR exam very well. Another advice, candidates should perform better at the theory questions, equally performing good at questions that require application of concept to the given scenarios. Here, some candidates they perform very well for theory parts, but when the, the for the question that requires applying standard, it is difficult for most of candidates. They don't even know. They can know, for example, if we are doing income, if it is a question about income tax, they should understand to differentiate between deferred tax, current tax, and taxable temporal difference, taxable temporal difference, but they don't know how to apply them in the question. So here, you should know how to extract financial statement and how they are accounted for in the books of accounts. Another advice, candidates has to effectively manage time in answering questions. Here, some candidates fail in the exam because of their speed. They don't have the required speed and they fail for that reason. They don't know how to manage questions in the exam. Some candidates spend too much time on questions they believe they could handle. This left them with little time to tackle another question satisfactorily. Remember, in the FR examination, they bring to you 4 questions. So, and you remember, exam has 3 hours, means 180 minutes. So you take 180 minutes divided by 4 questions. It means you have to spend 45 minutes per question. But some candidates, if you reach to the questions that you 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 know it, some candidates they spend too much time on one question, then they forgot that there are many other questions they have to tackle. So here you have to manage very well time. So to increase your speed, it requires more preparation by doing more exercises before entering in exam. For advice 4, candidates should be taught how to allocate time to questions according to the allotted marks and to strictly respect the time allocation. They should move to another question when time allocated is spent. When you are collecting questions and you see it takes you more than 45 minutes, jump it, leave it, and go to another question in order to manage very well time. And you have to respond to the question according to marks allotted to the question. For example, if the question has 2 marks, then you write 1 page or 2 pages for that question. So for that, you are spending too much time on one question, then you forgot to, to answer other questions. Another advice, candidates should attempt all questions and all parts of the questions. This increases their chances of scoring marks. Some candidates, they answer only one question in exam or 2 questions in exam. So here, you should attempt all questions and try to, to exploit all chances of scoring all parts of questions. Another advice, candidates should display very good handwriting in exam. This facilitates markers to allocate marks easily. Some candidates lack the ability to communicate effectively. They should not present their answers clearly. Some candidates they don't know how to present their answers clearly. For example, they bring uh, questions about consolidation, getting group accounts. You start from format, then you put workings after the format. And you have to show clearly all your workings. Because even workings, examine the markers, consider it, consider them. So focus on presenting your answers clearly, and you have to number your answers clearly because some candidates numbers their answers wrongly. And my advice to you, start a question with a new page. Another advice, candidates should demonstrate basic and relevant knowledge in accounting standards. Go and read financial reporting standard. It is on the website of ICPA, and master all IS and IFRS and IPSAS to, uh, to be covered in this FR book, and do many exercises, past papers of how to and know very well. And you have to be ready how to apply those standard in questions because it will increases your chances in passing exams. you have to know standard in order to pass this FR exam. And there are some key chapters you have to go through, and other chapters you have to go through. So another uh, side, it's about exam specific information, examination format. Here, I tried to give you how FR exams will look like, some instructions, and how it look like. For example, here, the exam contains 100 marks on exam content. The exam always has two sections. That is a mix of theories and computational questions. And there are some instruction in FR exam. Time around is 3 hours and 15 minutes. But 15 minutes is about reading, and 3 hours is about showing your answers. Question A has three compulsory questions. Here in this compulsory question, you should know that the question of consolidating group accounts, it always come in this compulsory question. You have to know, to understand consolidation of group accounts, published financial statement, and application of this accounting standard in different scenarios. Then those are key topics that come in these compulsory questions. Then the other chapters are covered in this section B, where you have choice of choosing one question. Here, section B has two questions. One question is you have to attempt only one question. One question. In the summary attempt, in summary, attempt four questions, three in section A and one in section B. Marks allocated to each questions are shown at the end of question and show all your workings. Even here, they clearly instruct you that you have to show all your workings very neat, very well. So this is how the exams will look like. The last slide, it's about analysis past papers, making links between different topics. For you as a candidate, go and download past papers in the ICPA website and compare them, and you will see some link between them and the most examinable topics. For example, for group consolidated financial statement, subsidiaries, associate, joint comparative entities, compare 3 years, the recent 3 years, December 2019, June 2019, December 2018. So when I compared all three papers, I saw that the question for group consolidation in financial statement, it always come. So here you tick and you read all of them, you see the link between them, and I know if you collect past papers, it will help you in this December, in this coming exam in December 2020. And also write every chapter and check past papers, those links between them, it will help you to know those are the key topics and others you have to know not to pass this exam. So the last session, it's about questions and comments. So here Strato. So facilitators uh, for this slide, the candidates that have, the participants that have questions, you should raise your hands. Hello, Stratton.
Hello, Enoch.
Yes, facilitators. This session of questions and comments.
Okay, one question from Q&A box. How can I
Yes.
get the note if possible? So I will share the note after this presentation to all participants. Will you please
Yes.
share with us a presentation on our email, the same as, could you kindly give us on clarification on the difference between proportion of net asset and fair value of net method in the calculation of goodwill in a consolidated statement and the dividend treatment in a consolidation?
Okay. So even others raise another questions because I want this session to be everyone should participate in this session. So this is the first questions. Stratton has answered it. Even the next one. So the last one, the third one is saying, could you kindly give us clarification on differences between proportion of net asset and fair value of net asset method and the calculation of goodwill in the consolidation statement and dividend treatment in the consolidation. So here, when you are doing consolidation, you are required to compute goodwill acquired from subsidiary. The goodwill acquired from subsidiary use two methods, proportion method and proportionate method or partial goodwill method and full goodwill method. For full goodwill method, here it is where you use net asset, non-controlling interest share of of net asset at acquisition. For full goodwill method, here you are given the value of net asset of non-controlling interest. So I don't know whether I can write it in the new slide to help you. But when you are doing a partial goodwill method, first of all, you start from cost of investment, and you add it NCI proportion of your value of net asset at acquisition. Here, if NCI, for example, has 20%, parent invested 80%, then NCI means has 20% shareholding. So you apply to 20% shareholding of NCI to the net asset at acquisition. So here, net asset, your value of net asset of subsidiary at acquisition at acquisition, as you know, net asset, it means asset minus liabilities, or it means equity. So here, you go to the balance sheet of subsidiary, then you write it details of equity. Here we can have share capital, share premium, returning the earnings at acquisition, fair value adjustment. Here, in simple terms, this is the revaluation of PPE. Because when a subsidiary is being acquired, the asset of subsidiary are 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 revalued. You have to adjust the value of the asset of subsidiary in order to know the true value of the farm. So here you add all this is components of a net asset of subsidiary. Share capital, share premium, retained earning at acquisition or pre-acquisition, fair value adjustment. Then the total of all of these items, it is called fair value of net asset of subsidiary at acquisition. Non-controlling interest for this is the partial goodwill method. Remember, partial goodwill method. Uh, partial goodwill method. Then for partial goodwill method, non-controlling interest proportion, you apply non-controlling interest share to this fair value of net asset of subsidiary at acquisition. Then once you take cost of investment plus this one minus this one, you get goodwill at acquisition. Goodwill at acquisition. Then you deduct impairment. Then you get goodwill balance. So here, uh, when I come back to your question, you ask it the difference between proportion of net asset and fair value of net asset method. So this one is proportion goodwill method or proportion net asset. You know, this is where non-controlling interest share. It is a proportion of this fair value of net asset of subsidiary acquisition. But for full goodwill method, here for full goodwill method, full goodwill method, in the exam you are given fair value of NCI, fair value of NCI. If you are given fair value of NCI, it means by the default you will use full goodwill method. But if you are not given fair value of NCI, you will use partial goodwill method. Because here, fair value of NCI, if you are determining fair value to use full goodwill method, provided what you do, you apply percentage of NCI to share capital of subsidiary, but using the market prices, the current market prices at date of acquisition. If, for example, the nominal value or par value of share price of subsidiary was 10, then the issued market price was 200 francs, for example, 20, to apply the, the current market value in date of acquisition is the one you apply it to the number of shares, then the value you get determine the value of NCI. So, but most this of NCI provided, it is not provided. You apply NCI shareholding to share capital of NCI, but using the current market prices at date of acquisition. So I think here this question is answered. Another question here is about dividend treatment in consolidation. Here, dividend is treated uh, depend on if it is pre-acquisition dividend or post-acquisition dividend. For post-acquisition dividend, percentage shareholding of parent is fully eliminated. Shareholding of parent on dividend from subsidiary is deducted from investment income, and also it is deducted from current liabilities from dividend payables. So the remaining part of NCI, it is deducted. The remaining part of NCI, it is not deducted. It is remain in the current liability, but for part of parent, it is eliminated because you remember intercompany debts between the parent and subsidiary is fully eliminated, it's fully cancelled because the parent and subsidiary, we assume they are a single entity. That's why part of parent dividend proposed by subsidiary, it is eliminated. For pre-acquisition dividend, it reduces cost of investment. Here, cost of investment less pre-acquisition dividend. It is deducted from cost of investment because those are dividend from pre-acquisition profit that you didn't share on it. So we can go to the next question. Are we using the module of second edition, February 2020? Here, Stratton will answer you. Another question referring to ISA 40. Why does an asset cease to be classified as investment property? Here, asset is ceased to be classified as investment property when it is sold. So when the asset is sold, it means you derecognize it. Or when the asset, when the construction of that asset is complete totally. For example, you are constructing houses. Then houses, all activities have been completed and you finish the building. So it means you cease to capitalize sorry, for investment property, when it is ceased to be classified as investment property. Yeah, it is that one. When it is no longer meeting with those conditions for investment property. You know, the primary objective of for investment property is you are holding investment property, you are holding PPE for investment purpose, for earning rentals or for earning rentals or for capital appreciation. When it is no longer meet with those conditions, it ceases to be classified as investment property. And as you know, for example, when asset you gain rental income, then it is no longer, you are no longer renting property to others. you are using for your own business purpose. So that is own, own occupied property. It is no longer investment property. Another question, what's the difference between preference share and ordinary shares? What about associate companies? For preference shares here, preference shareholders does not have voting rights in the decision of the company, while ordinary shares have voting rights. That's the first difference. Another difference is that the preference shares, they get their dividend first before ordinary shareholders. So when they are receiving dividend are first given to preference shareholders before to ordinary shareholders. Another differences is that preference shareholders given fixed percentage of dividend, while for ordinary shareholders they don't have fixed percentage of dividend. What about associate companies? Here, for associate company, when you are doing consolidation, you don't you don't consolidate associate line by line because we use accounting equity for consolidating associate company. When you are consolidating associate company, you determine investment in associate and it is initially recognized at its cost, then it is adjusted by post-acquisition changes. So this is how associate is treated in consolidation. Another question is referring to IS 12. Explain more on differences between temporary and permanent by an example. Here I have explained this one, but I can add something. For temporary differences, those are the differences um, that 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 occur between accounting profit and taxable profit and may reverse in the future. For example, depreciation rate. It is an example for temporary difference. For example, for depreciation, our PPE, we are using 20%. But for Rwanda Revenue Authority, for tax authority purpose, they, 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 in the RRA rules, they estimate computation of wear and tear allowance of, for example, 50%. If wear and tear allowance is 50%, then for us depreciation rate we use the 25%. It means we depreciate our asset in 5 years, while for other purpose it will be 2 years only. Means that in the first 2 years we will enjoy high capital allowance, but in the next other 3 years it will reverse. That is what we call temporary difference. Temporary difference may be taxable or deducted. But for permanent difference, here it occurs due to there are some income and expenses that are allowable for for tax calculation, for tax authorities, and there are some expenses or income that are not allowed. For example, fine and penalties. Fine and penalties are not allowed for tax purpose. It's a permanent difference because even temporary taxable profit and accounting profit will not reverse. So another question, briefly explain using equations. Debit and credit, how risks under IFRS 16 are measured initially in subsequent measurement. So here I can give you, let me create another slide. Let me create another slide. IFRS 16 releases let's say books of receipt. In the books of receipt, so initial measurement will debit. So we have to debit rights of use an asset, rights of use mm, you have to credit lease liability if there is some payment you made at the start of the year, you credit the bank, for example. This is double entry for initial recognition of initial recognition of freeze in the books of receipt. Then subsequent measurement, what you do at the end of the year, rights of use an asset, you have to compute its depreciation. So here, depreciation, an asset, when it is depreciated, you debit P&L account, then you credit accumulated depreciation. Accumulated depreciation. This is for rights of use an asset. For risk liability, that will go to the balance sheet. So here we have risk liability at the beginning of the year. You will add interest expense, then less lease payments at the end of the year. The remaining balance will be shown in the statement of financial position. Lease liability, CF. So this is the one that will goes directly in the statement of financial position. For this interest expense, it will go to, it will increase this liability, and goes also to P&L account. Here is debit interest expense Then the credit is liability. And remember, these double entries I'm showing to you. It's about when the raise is over 12 months, because when it is less 12 months, you expense it. You are no longer treat it as an asset. You expense it to P&L. But when the lease is over 12 months, you treat it as an asset and you treat it as liability. And here, this is when the lease is of high value. So in the books of RESA, in the books of RESA, here you have to determine whether it is operating lease or finance lease. You treat it, it depends whether it is operating lease or financing lease. But in the books of receipt, there is no need to classify lease under operating lease or financing lease. But in the books of RESA, you have to classify lease and as operating lease or financing lease. If it is operating lease, you treat it as an income to P&L, but on straight line basis. Straight line basis. But for financing lease, you recognize an asset and then you recognize net investment income. Or finance lease receivable. So another question here, uh, can you please explain why computing earning yield, preference dividend are deducted? So earning yield, this is for ratio analysis. Here you are determining earnings capacity of earnings per share. For preference dividends are deducted. Uh, this question is not clear. So Stratton, can you help me to answer other questions like the one asked by Ngabire
So the
Aline?
question is from Ingabire Arin. Are we using the model of second edition,
Yes.
February 2020? So the answer is yes, we're still using the material for February 2020, and we have planned to launch another edition in future, in the next years. So the CPA, all CPA are in the revamp process. We shall communicate once we made the change. But for now, we're still using the edition of 2020. So another question is from Jade Shema White's no correction of past paper in EICPA website. So effective from February 2021, we have planned to publish the question paper and the answer for all past paper. So, but for now, we publish only the past paper, no answers. I think all question was answered. So there is one person who need to talk is Karuhanga Koren. Koren,
No, Strato.
are you satisfied?
Yeah, very much. I even sent the questions, my three questions on IS40, IS12, and the IFRS 16.
Okay.
And I'm very, very happy for the presentation. And this is very wonderful. Thank you, Mr. Enoch.
Yeah, thank you.
Okay.
Yeah.
So
Thank you.
anyone with comment or question? I didn't David. I don't add in. I don't. Anyone with question can raise your hand.
Yes, hello, Strato.
Yes, Aden.
Yes.
Do you still have a question?
No question. I'm now satisfied with my questions. I'm wondering whether this session will come again in next week.
No.
Ah.
It's only one day, but we can share the presentation and the video for today's session.
Okay, thank you so much for clarification.
Thank you much. Thank you very much for all participants and your time you took to hear me. I'm grateful for that. I'm thankful for even ICPA for giving this opportunity to all candidates for preparing this December 2020, even though this pandemic of COVID-19 affected every side, every person here. But I'm grateful to the ICPA that think of this session to facilitate all candidates. So for any other questions, we will submit it to the Straton, then we will give you back answers. Thank you very much. Thank you.
Thank you so much, Enoch, for good presentation, even if it is in a hard time. And thank you so much for all participants for this session. I hope the package you get will be enough to pass December 2020 exam.
Yeah, thank you.
If there is no other comment, we can end this session by now.